Welcome to CandiMentor. Today, let's decode the complexities of lease accounting under SFRS 16. Are you preparing for an interview or just want to understand SFRS 16 better? You're in the right place. We'll break down key concepts, ensuring you're well prepared for any questions that come your way. Stick with us as we delve into this essential topic, providing clarity and insight into Singapore's accounting standards. What is SFRS 16? SFRS 16 is the Singapore Financial Reporting Standard for leases, aligning closely with the IFRS 16. It replaced the previous lease accounting standard, SFRS 17, and fundamentally changed how leases are recognized in financial statements. The primary goal is to improve transparency and comparability by requiring lessees to recognize most leases on the balance sheet, reflecting their right to use an asset and the associated liability. Why was SFRS 16 introduced? SFRS 16 was introduced to address the limitations of the previous standard, which often left significant lease obligations off balance sheet. This created a lack of transparency and comparability across organizations. By bringing leases onto the balance sheet, SFRS 16 provides a more accurate picture of a company's financial position, enhancing users' ability to assess the amount, timing, and uncertainty of cash flows. How does SFRS 16 impact lessees? Under SFRS 16, lessees must recognize a right-of-use asset and a lease liability for almost all leases. This impacts financial statements significantly, as it increases both assets and liabilities. Lessees will experience changes in key financial metrics, such as debt ratios and EBITDA, as lease expenses are now split between depreciation and interest, rather than being recognized as a single rental expense. What are the exceptions to lease recognition under SFRS 16? There are two notable exceptions: short-term leases and leases of low-value assets. A short-term lease is defined as a lease with a term of 12 months or less, without a purchase option. Leases of low-value assets typically include items like tablets, personal computers, and office furniture. Lessees can choose to apply these exemptions, accounting for these leases similarly to operating leases under the previous standard. How are lessors impacted by SFRS 16? For lessors, the accounting model under SFRS 16 remains largely unchanged from SFRS 17. Lessors still classify leases as either finance or operating leases, and the recognition criteria and accounting treatment for each type are consistent with previous practices. However, lessors must provide more detailed disclosures, offering greater transparency about their risk exposure and the impact of leases on financial performance. What is a right-of-use asset? A right-of-use asset represents a lessee's right to use an underlying asset for the lease term. It is initially measured at cost, which includes the amount of the initial measurement of the lease liability, any lease payments made at or before the commencement date, and any initial direct costs incurred. Over the lease term, the asset is typically depreciated, reflecting the consumption of economic benefits. How is a lease liability measured? A lease liability is measured at the present value of lease payments not yet paid, discounted using the interest rate implicit in the lease, or, if that rate cannot be readily determined, the lessee's incremental borrowing rate. This liability represents the obligation to make lease payments, and it is reduced over time as payments are made, with interest expense recognized on the liability over the lease term. What are the disclosure requirements under SFRS 16? SFRS 16 requires lessees to provide comprehensive disclosures to help users of financial statements assess the amount, timing, and uncertainty of cash flows arising from leases. This includes qualitative and quantitative information about lease terms, the nature of leasing activities, and the impact on financial statements. Lessees must also disclose assumptions and judgments made in applying the standard. How are variable lease payments accounted for? Variable lease payments depend on factors other than the passage of time, such as usage or sales-based metrics. These payments are not included in the initial measurement of the lease liability unless they are based on an index or rate, in which case the initial measurement uses the index or rate at the commencement date. Subsequently, changes in variable payments that are not based on an index or rate are recognized in profit or loss in the period they are incurred. How are modifications to a lease handled? Lease modifications can include changes in the scope or consideration for a lease. If a modification grants an additional right-of-use asset not originally included, it is treated as a separate lease. Otherwise, the lessee must remeasure the lease liability using a revised discount rate, adjusting the right-of-use asset accordingly. These adjustments ensure the lease accounting reflects the modified terms. What is the impact of SFRS I-16 on financial ratios? SFRS I-16 impacts financial ratios by increasing both assets and liabilities on the balance sheet. Commonly affected ratios include the debt-to-equity ratio, return on assets, and EBITDA. While debt ratios may worsen due to increased liabilities, EBITDA often improves since rental expenses are replaced by depreciation and interest. Understanding these impacts is crucial for financial analysis and performance evaluation. How does SFRS I-16 affect cash flow statements? Under SFRS I-16, lease payments are split between principal and interest components. The principal portion reduces the lease liability, shown as a financing cash outflow, while the interest portion is reported as an operating cash outflow. This change in classification affects the presentation of cash flows, highlighting the financing nature of lease obligations as opposed to operational expenses. What are the transition options for adopting SFRS I-16? Entities have two main transition options: the full retrospective approach and the modified retrospective approach. The full retrospective approach requires restating prior periods as if SFRS I-16 had always been applied. The modified retrospective approach, more commonly used, allows entities to recognize the cumulative effect of initially applying the standard at the date of initial application, without restating prior periods. How does SFRS I-16 interact with other accounting standards? SFRS I-16 interacts with several other standards, particularly those related to financial instruments, revenue, and impairment. For example, lease liabilities recognized under SFRS I-16 can affect the assessment of impairment under SFRS I-9. Additionally, the standard's requirements for lease term determination may impact revenue recognition under SFRS I-15. Understanding these interactions is essential for comprehensive financial reporting. What are the challenges in implementing SFRS I-16? Implementing SFRS I-16 poses challenges such as gathering accurate lease data, assessing lease terms, and determining appropriate discount rates. Organizations must also update systems and processes to comply with the standard's requirements. These challenges require careful planning and resource allocation, emphasizing the need for cross-functional collaboration between finance, operations, and IT departments. What are the benefits of SFRS I-16 for stakeholders? SFRS I-16 provides numerous benefits, including improved transparency, comparability, and accountability in financial reporting. By recognizing lease obligations on the balance sheet, stakeholders gain a clearer view of an entity's financial commitments and operational leverage. This enhanced visibility helps investors, creditors, and analysts make more informed decisions, ultimately fostering trust and confidence in financial statements. If you found this helpful, don't forget to like, subscribe, and hit the bell icon for more insights from CandiMentor. Drop your questions in the comments, and let's master lease accounting and other financial standards together.